Anu, thank you so much for joining Dealcast. Welcome on this sweltering day in London. I think the only thing hotter at the moment is the M&A market in 2026 so far. Sorry, corny, but...
yeah, we are competing with the weather here.
We are a bit, yeah. So, listen, if you had said to me at the start of the year, or perhaps over my New Year's Eve glass of champagne, we're going to have a NATO alliance argument about the status of Greenland. We're going to have a war in the Middle East that chokes off one of the Strait of Hormuz and leads to snarls in supplies of energy for 3 months. We're going to have an inflation bump that means that the Fed can't cut rates the way it had intended to. If you'd said that to me then, and then told me, but by the end of the first half, we will have had the busiest first half on record, $3.16 trillion of deal making, I wouldn't have believed you. Yeah. So now the striking thing about that, I think, is that 78% of that deal volume is from strategics. What do you think is what is driving the audacity of boards in undertaking these transactions?
Yeah. Firstly, when we picked this date, I should have had a better crystal ball on what the outside was going to be like. So I can attest to the fact that it's hot. And both, I guess, here in London as well as in the M&A market. You're right. But I think we've had now a few different time periods like this, haven't we? In 2020, when, the world shut down and for 6 weeks there, I thought the M&A business was going to be shut down.
Right, yeah.
And then we had the next, from middle of 2020 to middle of 22, one of the busiest and highest volume time periods in terms of M&A activity. And then last year, likewise, when Liberation Day happened.
There was a bit of a pause, but my God, the second half.
Yes, exactly. So I feel like by now, the resilience of boardrooms in being able to absorb shocks and work their way through it is battle tested.
Yeah.
And in some ways, when it's any one thing, you really obsess over it, right? Because like, how am I going to change my model for this one thing? And how should I run the sensitivity, whether that is oil prices or interest rates or whatever? Well, I just changed 65 things on you, and I do that today, and I do it an hour later, and I do it again tomorrow. And the number of things are all different all the time.
At which point you may as well just chuck out the rule book and and go, you know what, I have a strategy, let's pursue it.
Exactly. And so in an odd way, it's shifted the focus from short-termism, which by nature of this quarterly earnings schedule and the way corporate world works, you're a little bit...
Well, it's quarterly for now, but...
but it's a little bit focused on that.
Yeah.
And you've had to move away from that because while in the short term, it has become really hard to predict things.
Yeah.
When you look at should this company buy this company, should this company merge, the answer to that as a long-term question, as a strategic question, is clearer.
Yeah.
And in an odd way, this level of uncertainty has allowed boardrooms to rise above what is happening in the market today. Not all the time.
Yeah.
Because you cannot, because there are some places where it is that level of uncertainty that drives you to do the deal.
Well, I was going to say, because it seems to me that there's almost like a heads I win, tails you lose kind of ratchet aspect to M&A, in the sense that if there, we are living in a world of geopolitical, the kaleidoscope is in flux, as it were, in terms of the geopolitics, and alliances are breaking, new alliances are forming. It's difficult to predict how that runs out. And so building resilience, as much as executing growth strategy, but to what extent is resilience, whether it's market access or securing supply chains, more of a driver than growth, or are they complementary in this environment?
Yeah. So I would say the kind of big themes: scale, simplicity of the company, strategic, whatever it is that you are doing. So it's not scale for scale's sake. It's not simplicity for simplicity's sake. It first needs to chin the bar of being strategic.
Yeah.
So whatever it is that this company is doing, is this action, is this deal of strategic merit and fit? Once it chins that bar, why is it that scale is something that people have been chasing? Because the markets have rewarded it.
In valuation terms.
Same industry, same sector, larger company trades at a better multiple or trades at a premium to the smaller company.
Yeah.
At the beginning of this year, the scale premium in the US was at an all-time high. It's come down a little bit. In the UK, actually, in Europe, it's now at an all-time high, the scale premium.
Yes.
And so you see companies saying it is as much work to do a $100 million M&A deal as it is to do a $1 billion deal, as it is to do a $10 billion deal, depending on the size of one of the companies. And so deals of scale has the ability to move you into a different stratosphere in terms of valuation multiple, comp set, and peer group.
And builds resilience,
And build
especially
resilience.
if it's cross-border.
Yeah, not just for cross-border, if it's supply chain.
Right.
Right? And so all these risks that you are facing in the world, whether that's geopolitics or technology related, whatever it is, the risks that you face, your ability to navigate those risks seem to be higher when you have more levers to pull.
Right.
So you're a larger company, and that way, with that synergies come the ability to reinvest in whatever it is that you reinvest in, whether that's securing your supply chain, securing your AI capabilities, whether that's cyber, whatever it is that you're trying to address, you're able to address that by using this money as opposed to spending your own money.
And that's writ large in the statistics as well. I mean, we've had, 48 mega deals of more than 10 billion.
Yeah, about 1.3 trillion, I think, of the volume comes from.
Exactly, yeah. And that's just an astonishing growth. And it's testament to the factors that you were talking about. It's interesting you mentioned about the strategic elements of it, because I mean, if we look at a deal, for example, the GOP EQT takeout of AES, for example, obviously a global energy player. Energy is one of the great themes. We're going to continue to see electrification right the way through, from resource mergers through to transmission, generation, etc., etc. Another theme, of course, is defense. Particularly, it has to be said, in Europe, where there's a push for strategic autonomy. Are there other strategic sectors that you think are going to be critical in the next 6 months or maybe the coming years?
Yeah, and these themes haven't gone away, right? Energy theme has morphed a bit because it started with energy transition. And now the focus is both on oil price and how do I deal with that, as well as AI build out.
Correct, yeah.
And that's a whole value chain. Energy is one piece of it, but it's cooling systems, it's real estate for the data centers, it's cloud, it's quantum, right? So it's every variation of that ecosystem.
Yeah.
That people are thinking about either acquiring the capabilities or interesting financing structures for its build out through partnerships, right? Whatever it is that you've seen Apollo and Blackstone and others do in the case of the Meta deal or the Intel deal and things like that to facilitate the build out. Or you have NVIDIA taking positions in various companies as a way to help with the circularity of the AI space. So I think you see that sector and or even acquirors, right, which is a concept which always existed, right, because people always thought about what am I missing, and sometimes it's your CEO succession that comes from buying a company. So it's not a new concept, but I think the word is new.
Yeah.
Buying a company for talent named acquihire kind of sounds cool, right? So
yeah, absolutely.
And we've seen a lot of that too. And some other places where activity has also been very high is in the industrial space.
Right, yes, which had been something of a laggard.
Yeah. And so you've seen tremendous amount of activity because in some ways when there's a lot of things which are uncertain, people go back to things that I can touch and feel and count.
Right.
And in the industrial space, scale has been a big driver.
Right, yeah.
And you've also had a lot of mispricing in the public market.
Correct,
right?
yeah.
So you take the, this is a U.S. statistic, so you take the S&P 500. If you go back 10 years, 20 years, the top 100 companies in the S&P 500 are probably 20% of the value, 30% of the value. Now the top 100 companies are close to 70% of the value.
Right. Heavily concentrated.
Heavily concentrated. The top 10 companies were like 35 or something like that of value. The bottom 100 are 2% of the value. So you still, despite having record levels of the S&P index, you have mispricing, valuation mispricing, where there are good companies, either because of lack of scale or because they are not relevant to the current investment themes in the market, are mispriced. And so there's deal activity that happens because of that.
And we began to see a bit of an upside correction on that at the beginning of the Iran crisis. I remember there was the talk of rotating into the so-called halo stocks, right?
Yeah.
Like heavy asset, low obsolescence.
It's less in the equity markets. I think it's been more in the M&A markets that
Right.
you've seen activity happen. Services,
Yeah.
where you've seen a lot of activity, because services, again, is very localized. And as you have tighter immigration control, the people as a resource has become pretty valuable,
Yeah,
very
both sides of the pond.
domestic,
Yeah.
insulated from tariffs. And so the services part of the business has also been very active in terms of M&A activity.
One of the areas where, of course, people have been wanting to acquire for talent, and you mentioned it a couple of times now, is in AI. Now, nobody is going to dismiss the generational nature of this technology. It's here to stay, and it's making huge changes in workflows and so on. I think the question is, though, and particularly in the context of the hyper concentration within the stock market, the degree to which valuations have maybe got out over their skis.
Yeah.
And that then has an impact, because if there is a correction in those stocks, it trickles down and could impact valuations for deal making by creating a downward correction on the valuation benchmarks of some of those
or
deals.
rotation to something else, right? You don't know.
Exactly.
And
what's your view of all that landscape?
Part of the challenge has been, how do you evaluate the success of AI?
Right.
So I agree with you. The part of it is it here to stay? Is this a trend that companies need to understand to navigate, invest in? I take that as table stakes. But then how do you measure the success of it? What does good AI look like versus not good AI? And I don't mean from a social implication perspective. I just mean just as a technology, any investment you make, not just technology.
Yeah.
I'm spending money on CapEx. Normally on a project, I know I'm going to invest this much. This is the year-by-year cash flow. Here is when I know something went wrong. Here is what good looks like.
Yeah.
And this is my ROI on the project.
Yeah.
Expected ROI, contingent upside. That has been much harder to define for most companies in the AI space, because they're like, I have to spend because otherwise I'm going to get left behind. Okay. And the smaller benefits that something used to take 8 hours, now it takes 2, or it takes 20 minutes, whatever it is, right? That you can quantify. I think people have become a little bit better at that because it's observable. But then let's say it's 8 hours became 20 minutes. What are the human beings doing with the 7 hours and 40 minutes that you got back?
Right, yeah.
Is that going into innovation? Is that going into selling more, making more? What is that going into?
Right. And we've had, I mean, for example, like there was famously an interview with the Uber CTO a few weeks ago where he was saying that they were able to identify individuals or individual tasks where there were significant productivity improvements, but it wasn't necessarily bleeding through to new consumer applications. And they were finding it difficult to create the connection between individual productivity gains and productive capacity. And
organizational capacity and the organizational ability to redeploy that capacity.
Right.
And do you need to talent train the people? What is it that you need to do to redeploy it? And so some of it is, I'd say, relatively on the easier side, right? Because if you were saying, oh, I'm going to do this, I would normally have to hire 5 people, but I can do this and maybe I can redirect that. And then you have to ask the question, but are they the right 5 people?
Yeah.
The capacity I freed up?
Yeah.
Do I have to do something to train them? And the other, I think, difficulty that a lot of larger established companies have is, are you reimagining your process using AI, or are you using AI to make an inefficient process work faster but still inefficiently?
Yeah, exactly. No, I think that's absolutely right. The business author Dan Davis, he wrote that AI can make poor workers efficient too. You can scale up their inefficiency or scale up their ineptitude and incompetence.
Yeah.
To take it to a more serious level, I think we've seen even with the job losses, for example, that were announced at Microsoft, they were very clear that they were not AI related. But they were related to how AI is changing the business. And I think that relates to what you're saying about you may free up capacity, but is that capacity the right capacity for your strategic purpose?
Yeah.
I think that's very, very clear. With AI, of course, there has been, if we think back to the earlier part of the year and the initial release of the Claude Cowork plugins and the SaaSpocalypse or SaaSmageddon, whichever your preferred version of that is, there was this read through to, oh my God, what's that going to mean for software companies? And it has to be said that private equity were both sides of the pond, actually, very heavily invested in software and business services adjacent companies that felt the chill of that moment earlier in the year. And that bleeds through into that comes through into the sponsor M&A data. Sponsor M&A aggregate is only up 2% year on year.
Yeah. I'd say there's a few drivers of that, though, right? Because what is the traditional sponsor model, right? You buy a company, you'd say the hold period is approximately 3 to 5 years or 4 years midpoint, which meant every year 25% of the companies need to monetize. In 23, 24, 25, it's been 10%.
Yeah.
That doesn't work because now my hold period just became 10 years.
Yeah, exactly.
Right? That's not how these
Which is perilously
deals...
close to the life cycle of the fund.
Yeah, that's not how these deals were underwritten.
Right.
And one of the biggest kind of circles of how this works is you need to be able to take the company public. The public equity markets like some type of deal. So it's not like there isn't appetite for IPOs and things like that.
Right.
There's some very large IPOs there.
I can think of one or two.
Yeah, exactly.
I mean, SpaceX wasn't too shoddy.
And so there is plenty of money available in the equity capital markets. There is interest in the right type of business becoming public. But it's not the exit route, the normal base case exit route. So if you're in an investment committee today and somebody's bringing up a deal and they say, oh, this company is mispriced, I'm going to take it private and we're going to do A, B, C, D to it, and then I'm going to take it public again.
Yeah.
The chances are that investment committee says, no, you're not, because there are companies like that. At the end of what you're going to do, you're going to come out, you're still going to be like a $2 billion, $3 billion, whatever company. You're not going to hit the scale requirement for a lot of index funds, yes, to hold you.
Yeah, and index inclusion is increasingly table stakes for this. I mean,
yeah, it's a big value driver, I'd say, right? Because you see a company that joins the index and the valuation goes up 15%, 1.5.
Yeah.
There's no corporate finance theory that says the same company is valued on a Friday 15% higher than a Thursday, right?
But the index jockeys do their work, right?
But it's supply demand.
Yeah.
So it's not illogical. It's once you're in the index, all the people who are index holders need to own you. And so they all buy. So there's buying demand. So it kind of makes sense. But still, from should this company trade 15% higher? And should the company which comes out of the index, should they be 15% lower? If I did the reverse, that doesn't seem to make sense, right? So But again, it's logical because if you're an active asset manager and you have to beat the index, you can't beat the index by buying tiny companies. I got to make massive bets in order to beat the index, especially when the index has been going in one direction.
Well, and with so much passive money on the table, right?
Yeah. So on the private equity side, it's been a few different things. You're right. There are some firms. You could have taken the whatever you called it, Sascalypse or Sasmageddon or whatever that was. You could have taken that as a huge buying opportunity.
Yeah,
because that was software mispriced.
Well, that's what Tom and Bravo have been saying. They're saying they're seeing dollar signs to go out and buy in the market, right? So there are voices
but
there
not
suggesting
as many. There were a few deals that happened, but not as many, because there is also certain voices which say that no, you really need to think about what is the terminal value of this business, what is going to happen. Our company is going to renegotiate the economic terms of these long-term contracts that exist with these providers. But on the other side, again, for large companies, it's not that simple that you wave a magic wand and everything becomes AI.
Well, no, I mean, I agree with that. But equally, like, just to come back to the pricing point that you were talking about, investment committees going, well, I don't know whether this business will even survive in 5 years' time. You're telling me that it has a 45-50% EBITDA margin today and that it's got contracts out 5-7 years. But I don't know in 5 or 7 years whether they will renew.
Exactly. And there are some people who took a very negative view, which I don't agree with, is that the terminal value is zero.
Yeah.
And in fact, like if you had to explain how the market was trading it, that's kind of what you had to believe in to make sense of some of these numbers. Yeah. And maybe for some companies that is true, maybe. But to paint the entire sector with that brush seemed a bit draconian.
Well, I mean, one thing I think we have begun to see already as we are into the later in the second quarter, and I suspect we'll see. Yeah, you tell me if I'm wrong. I think we'll see in the second half a great deal more discernment in terms of running the rule on some of these businesses and understanding of the data moat or the relationship moats that they have. That seems to me to be logical. Are you seeing some of that?
Like with anything, right? Immediate reaction is, I want to step away, wait and see what happens. Then you learn, understand, and then the market finds the opportunities where it makes sense to invest. But having said that, for private equity, there has to be a path to monetization.
Yes.
It doesn't need to be full monetizations, and that is what has been very popular, partial monetizations, various versions of it. And of course, the holy grail is you find a strategic and you sell to the strategic.
And there seems to be plenty of appetite that side.
Yes.
If the asset is big enough.
Yes.
I mean, the AES take private that I mentioned, $45 billion. There's plenty of appetite for take privates as well, right? It seems both sides of that coin are true. If the scale is there, you'll find strategics to buy those assets, and you'll find sponsors, whether clubbing together or by themselves, putting money on the table. I mean, we're only a couple of weeks, I think, after the Intertech deal, obviously the testing, inspection, certification player, that is being taken out by EQT in a £10 billion deal, one of the largest take privates in UK history.
Yeah.
So if the scale is there, you'll either find a strategic or you'll maybe find a secondary sale or a...
Yeah, I'd say it's more than scale. There also needs to be a story around that, right? Because there needs to be a thesis. So you start with the valuation of the company. But just because a company is not priced correctly doesn't make it a good take-private candidate. The question that you have to answer is, what will you do with this company differently if it were private instead of being public?
Yes.
And is that a temporary thing or a permanent thing? Because if it's a permanent thing, meaning like whatever it is you're going to do to that only works as long as you're a private company, that may not be a private equity or owned asset. So usually there is a thesis or a case for, there are some things I need to do to this company which are hard to do while it's a public company. So I need to take it private, do that, and then take it public again.
Yeah.
Right. So like earlier this year, we had OneStream and Clearwater, some exceptions to the software deals not happening type situation where private equity did act, but there was the examples are few and far between.
Yeah.
There was another thing you mentioned about UK, and since we are here, UK M&A volumes in the first half more than 3 times last
That's
year's
right.
volumes.
That's right. $255 billion in dollar terms. Yeah, $255 billion.
Yeah.
I guess one of the questions I have, I'll come back to something on private equity in a sec, but while we're on the UK, is that because the UK is a beacon of stability and things are going well in the UK economy? Or is it actually, as I suspect, that we just have a large number of undervalued, very international companies?
I'd say a few more things I would add to that is one, the UK market is a seasoned M&A market. People know how to do deals in this market. There's a process, there are precedents, the investor base is evolved, developed. Here is, if you're thinking about, I want to do deals in a market, US and UK are in a class in terms of where there's just plenty of precedents. And so the comfort level of, can I diligence a company? Can I understand a company? Can I trust the public reporting? Is there enough precedence? Is there case law? All of that, the comfort level for boards in buying a UK company is high.
Yeah.
Because in some other jurisdictions you may have interest, but the ease of completing the M&A deal is not the same.
Right.
From procedurally. It doesn't mean shareholders are not going to ask for more money
Sure.
or this or that.
We saw with Intertech, there was
or the regulatory process. It's not that any of that is lax or anything.
Yeah.
It's just that there's plenty of deal doing because there's a lot of companies.
Yeah.
And then you add on top of that the mispricing and the belief that in the future, having this asset makes the acquirer do something with it that is better.
Yeah.
So oftentimes the strategic rationale is not focused on UK alone. The TAM and the market that you're looking at is a global market.
Yeah.
But the capability or the asset that you're buying is a UK asset. And you have a lot of assets that are UK assets, but are really global companies with a global footprint.
Yeah. I think when we met last time, we were speaking about these London in name only, the Lino stocks, right? I think 75% of the profits in the FTSE 100 are derived overseas. So it's a very international market, and there's plenty underneath that level in the FTSE 250 and beyond. With the UK though, we have seen a slight regulatory shift even in the last few weeks with the Lisa Nandy thinking of intervening on the Warner Brothers deal, and obviously the Shutterstock Getty deal. There was a bit of a snafu there with the Competition and Markets Authority. The regulatory environment is changing. It seems to be a little bit more in flux in the UK. By contrast, in the European Commission with the new merger guidelines, there's a big push towards the development of European champions, and in the States, Mr. Ferguson as head of the FTC is a very different prospect from Lena Khan, who was the previous incumbent. So in terms of the regulatory aspects, they seem to be in flux, but broadly speaking, the UK is a bit of an outlier perhaps, but the European Commission and the US, for different reasons, and with different motivations, it has to be said, appear to be more accommodative of large deals. Is that part of the thinking on boards' minds as well?
I'm not sure the data would show that it's getting approved any faster or anything like that, because the time period for how long an M&A deal takes and how contracts are written around that is still pretty long.
Yeah.
And strategics need to get comfortable with that, right? Need to get comfortable with holding the business together between signing and closing when you announce a deal. And the focus on all of that is still there. And I'd say there's a few things that have changed. One is boards kind of accepting that as the new world, right? Because there was a sense that, maybe this is temporary and it will go away. It's under this administration, that administration. And if you go back over the last 10, 12, 16 years, you'll see that it has just taken longer.
Yeah.
We would describe it as 6 to 9 months, and it became 9 to 12, and it's like 12 to 18.
Yeah.
And
I mean, I remember people first mentioning CFIUS as a problem, the Committee on Foreign Investment in the United States, under the Obama administration. So the idea that there's a sudden change, no, it's been quite a long...
Yeah. So I'd say the regulatory environment has been in flux or evolving, and there is not, I was going to say perfect, I'd say maybe I could say there's not a lot of coordination between all the different jurisdictions.
Yeah.
And sometimes you have deals stuck because of any one country somewhere.
Right.
Right. And you're like, how is this possible? This company operates in 42 countries and we have 41 approvals, but the deal can't close, right? And so it is not easy to navigate. But having said that, the strategic merit of doing the deal is high enough that you say this is a little bit of the cost of doing business. This is how long it takes. And then there's also a little bit of a sense in the US that you're dealing with an administration with whom you can have a conversation and a negotiation.
Right.
Because there are examples of deals where in the beginning the decision was maybe we are not going to approve it, or you get a lot of questions, but then you're able to work through it and get to a solution.
Well, I've heard from many deal parties, I won't name them, but I've heard from many deal parties about the ease of access to White House officials in particular, and even on occasion the president himself, in order to at least have a discussion about these issues. And we've seen, obviously, with the recent Supreme Court ruling that kind of struck basically the Humphreys executor precedent, that the agencies are much more tightly controlled from the administration, from the White House. The appointees are kind of able to shape the agenda in line with the president's. Is that access something that helps to grease the wheels a little bit?
So I think the White House having a business person and a lot of people from private sector being in the government, I think those two are new things.
Yeah.
But the fact that the government appoints people to these roles, that's just how it works, right? I mean, when there's an administration, Lena Khan was also appointed by somebody, right? So I don't think that's a new thing or anything weird. That's is an appointed position, and usually there are people of Republican leaning and Democrat leanings and things like that. But the number of private sector people or business people who are in the administration and the level of engagement, direct engagement, is something that I haven't seen before.
Yeah.
And that is different because not only are you speaking to somebody who's a part of the government, you're also speaking to somebody who understands how to look at a term sheet.
Right.
Or even
what a term sheet is.
Yeah. Right. So I think that's different.
Yeah.
And so there is a little bit of a sense that, I can handle that because I can talk through these topics and either will agree or disagree or will negotiate.
Sure.
But it's not like I don't even know what it is you're thinking. I can't see you. I can't speak to you. And a decision is just going to come to me. I think people feel comfortable if I can have a conversation. And I'd say that's true for some of the other regulators too, where it's changing, where you now actually can have a conversation. You may not like what you hear.
Right, of course, yeah.
You may not get a favorable decision, but engagement by regulators with business, I think it's a constructive trend.
And just to stay on the US perspective for a moment, obviously we do have the midterm elections coming. You mentioned just now that the pendulum does swing. It could swing again. We don't know, but it looks like there could be some changes in Congress come the autumn, come the fall. Is that November election date part of the thinking of boards and sponsors in terms of their M&A sequencing, or is it more, as you said earlier, that you just have to ignore this noise and plow on?
Yeah, I mean, does it come up as a part of the conversation? It does. Is it a primary driver? No. People don't start by saying, oh my God, I got to figure this out. There was 1 or 2 years when there was this sense that tax law is going to change by December 31st, and there was heightened activity in November. I can't remember which year that was. It's not like that. But is it something that people consider to say, when I look at everything that is happening, do I want to navigate my deal in this current environment? And you may conclude, actually, I do, because at least I can speak to people and navigate it. So that I'd say is probably secondary or tertiary consideration, not the primary driver. Primary driver continues to be boards also really forward-leaning with the management team, and oftentimes pushing the management team to think bigger, to think more strategic. Because doing deals is hard, and it takes up a lot of management time. So from the beginning of my career, where I would see that deals were often, management would do everything and you would just kind of go ceremonially to the board to get holy water thrown on it, to boards now actively involved. Most boards will have at least an annual strategy session. Where should this company go? Really get involved in what are the targets we should look at? What are the merger partners we should look at? How should we grow? How are we going to drive growth? Are we going to drive growth organically? Is it going to be through, bolt-on acquisitions? Are we going to do something transformational? If so, with who? What is it that we should do today to develop that optionality, right? And that's the type of conversation which 20 years ago, boards were not involved in. Management teams would have the strategy session. But now most boards will have a strategy meeting, and they would all be facile with all of these details.
Well, the cliche, certainly here in London, is that a non-exec just goes and has a lovely lunch, 3 bottles of claret, and and sort of rolls home and doesn't do any. That's changed completely, I think. That you're very much an active driver of the business. Now, you're talking about boards having that impetus on corporates to transact and on executives to transact. There's a similar dynamic. I said I wanted to come back to private equity. LPs are obviously desperate and pushing portfolio managers to monetize those assets. And I wanted to come back to this because it seems to me that one of the problems in terms of getting this overhang of exits done is that a lot of the GPs have aggressively marked them to market. And they've probably done so off the back of multiples in 2020, 2021, 2022. I have a view that even if they have aggressively marked, they need to transact when the market is at the highs that we're seeing. You're not going to have the valuation benchmarks, the comps, as high. Maybe, who knows what will happen if there'll be a market correction in 6 months, 12 months, a year, whatever.
But you're not the person who underwrote the deal, and it's not your career and your carry that's going to be influenced by that.
But that's true. But okay, so how do you square that circle? Because it seems to me like if you're going to, I'd rather exit now with the valuations in the market where they are, then wait for a market correction and then find that my comparable basket is a lot lower.
So what people are doing is partially monetizing it, right? So last year, 20% of sponsor exits was through continuation funds. Which is the highest percentage that you've seen. And you may see that number be even higher this year. And the continuation fund has also changed a lot because it began by people saying, I'm going to take my worst assets because I cannot sell them. And I'm going to bunch them up and throw it into this continuation fund and at least get some money out. And then I think the light bulb went off and we were like, wait, so I'm going to continue to own my worst assets and sell my best assets?
Yeah, my trophy assets, which I still feel is a really good runway to monetize. Yeah,
so why would I do that? And so, which is why originally continuation funds was like a bad word. And now it's actually pretty good, healthy part of the market because many companies are taking their best asset sometimes and putting it into a continuation fund.
It's very much like a trophy asset vehicle these days, right?
Yes,
single asset.
More so.
Yeah.
There'll still be some of the other type, but majority it is moving in that direction of saying which is another way. If you start by saying, if I look at my portfolio, which are the assets that I would like to continue to own, or I don't mind continuing to own because I think there is more upside. And which are the assets where I feel I should cut my losses?
Yes.
Then you categorize them differently.
Yeah.
And there are some monetizations, or what you're more seeing is, if not through a continuation fund, sometimes you're combining assets of two sponsors.
Yes.
to create
Yes.
a larger entity.
To get the scale that we've been talking about the whole time.
Exactly.
Yeah.
So I feel like more deals of that type could happen,
Yeah.
should happen.
Yeah.
There's a few that have happened, but not as many as what can.
Yeah, I feel like the platform combinations have not come through in the volume I would have expected to deal with the overhang.
Yes. And because the vintage at which one private equity firm invested and the other private equity firm invested don't perfectly line up.
Yeah.
So if I am 4 years into it and you are 7 years into it, and we're talking about a combination, I may have more patience to exit. Whereas you're saying I need to take at least some cash out now because I'm in year 7. So then I'm like, okay, but I need to now pay you. Where is that money going to come from? Or do we need to redo these debt structures because that may have some cost?
Yeah.
Because right now I have traveling debt or whatever it is.
Yeah.
That's where a lot of these things get stuck because the vintage of the asset is a little bit misaligned. So it requires somebody to swallow hard and do one or the other.
Well, we're seeing with a lot of refinancing that it's being done on a portable basis now to allow this. Sorry, I interrupted you.
Yeah. No, but it's the same. Either I have to say I will pay you some, or you have to say I'll take a little less to make the thing work.
Yeah. Perfect. I'm conscious of time. I do want to kind of get to the kind of crystal ball aspect of this while we have you here. We're at the turn of the half. There's it would be. I think it would be foolish to imagine that the latter half of the year will be anything other than sustaining the activity that we've seen. But I just wondered, do you envisage us ending? Basically, we had a first half of record.
That was
proportions.
a record, yeah.
Are we going to beat 2021?
Yeah. Fingers crossed.
Yeah.
Feels that way.
Yeah.
Because the level of activity continues to be very high. And we look at the pipeline and all the things that is there in the pipeline. Good quality stuff, right? That people want to make happen. Availability of capital to make these deals happen. Investor support for the deals, or even if the investor is not immediately supporting the deal, which has happened in some of these large deals, which are obvious deals that should happen, but the stock market has not been, immediate reaction has not been favorable, and boards and management teams have said, that's fine. We're playing, again, coming full circle to how I started, is the same agita that I may sometimes have seen earlier. Oh my God, my stock went down as soon as I announced the deal. And again, people want the market to react well and all that.
Yeah.
But the existential crisis of did I do a wrong thing?
Well,
is less so, because each deal, by the time it gets to the finish line, has gone through a lot of work and a lot of vetting and a lot of analysis, such that the conviction around that deal is pretty high from a strategic perspective. And again, it's a long-termism that in 5 years, this deal is going to make sense. So today the stock market reacted badly. I'm not going to fuss about that. I think that's a relatively healthy sentiment as well.
Yeah, and I think it runs contrary to, I think, the popular understanding of how boards are thinking, right? I think the popular, out there in the wider world, I think most people are thinking about them as very short-termist, only for, the Jack Welch way, only focused on the next quarter, EPS go up. You're saying there's a degree more maturity in thinking longer term than the popular perception implies?
Yeah, because you can't. Because you don't, the velocity of the news cycle, the unpredictability of it, and the difficulty in even translating the implication of a piece of news to your business is not a straight line at all. Because when you read a headline and you're looking at a business and say, is this good for the business or bad for the business? Ask a lot of CFOs. It's not clear.
Yeah.
Because you could look at that and say, well, that could be good. This could be bad. This could be good. This could be bad. And it's a put and take. And at the end of it, I can't just do it like that. Some things you can, right? If you're in a business where you're using oil and oil price went up, okay, pretty easy, straightforward, right? Whereas lots of the things are a lot more nuanced than that.
Yeah.
Which again, I think makes the focus on I can't control what happens today and tomorrow, but I can influence and I must influence what's going to happen with this company 3 to 5 years from now.
Yeah. And this is a good opportunity for our viewers and listeners, because this is a time when they're not going to get a bill from you, right? There's no fee to pay. Is that the key takeaway for them? that they've got to think, whether they're founders or executives at more developed companies, it's that long-term thinking that's going to win out in this kind of market.
It's proactivity. Right, because again, not sitting and waiting for an asset to come to market or waiting for somebody to call you, right? So proactively think about where is it that you want to go? And then what actions do I need to take in order to make that vision a reality?
I think that's a perfect place to leave it. Thank you so much, Anu, for joining Dealcast.
Thank you, and we didn't melt.
No. Well, I got my linen suit, so the viewers will see my perfect threads, and they'll see how beautifully dressed you are as well. But so we can encourage those listening on Spotify or on Apple Podcasts to maybe take a look at the video. There you go. We've given them a real incentive to do so. Anu Aiyengar, thank you so much.
Thank you. It's a pleasure being here.